a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, Happy New Year and welcome to Exploring ETFs. I'm Neena Mishra and today we are talking about best and worst performing ETFs of 2022. So we know that last year was a brutal year for stocks and in fact for bonds as well. The S&P 500 fell 19% and this was its worst performance since 2008. The Dow was the best performer. It lost only 9%, and it was the Dow's best comparative performance versus the S&P 500 since creation of the S&P 500 benchmark in 1957. That is according to the Wall Street Journal data. The Nasdaq plunged 33%, worst performance among major indexes as technology stocks were beaten down. And this was the Nasdaq's worst underperformance versus the S&P 500 since 2002. Energy was the best performing sector. Again, this was up almost 48%, and communication services was the worst performing sector. This was down almost 38%. All three major indexes had entered bear market in 2022. And while the Dow exited its bear market, the other two were still in a bear market territory, which is down more than 20% from the recent high. Now let's take a look at the best performing ETFs, and there are some surprising ones. The iShares MSCI Turkey ETF, ticker symbol TUR, was the best performing ETF. It was up more than 100%. This was a big surprise because the Turkish economy is in a big mess. Inflation there is around 80%. In fact, it had exceeded 85% around October, but the central bank in Turkey shocked all experts by continuing its interest rates cuts to boost growth, which caused their currency, the Turkish lira, to plunge almost 30% against the dollar. But domestic investors, the domestic Turkish investors, continued to pile into Turkish stocks because they were using stocks as an inflation hedge when inflation was too high. US investors did not like the Turkish ETF despite its performance. Normally, US investors tend to chase performance. So this ETF actually lost assets during the year, even though it's surged. So this remains very risky. The other best performer, the second best performer, was this actively managed interest rate hedge ETF, which seeks to hedge interest rate movements against rising from long-term interest rates, and it also benefits from market stress when fixed income volatility is up. Then VNEC oil services ETF, oil and natural gas ETFs also did pretty well among energy ETFs. This ETF, oil services ETFs, were better performer. This was up about 66%, and natural gas ETF was up about 57%. Let's quickly take a look at these ETFs by going to the quote pages on Zacks.com. So this is the Turkey ETF. If you want to learn more, you can go to the web page using the link on our website to learn more about this ETF and what it holds. But as I mentioned, the Turkish economy is in a mess and this remains very risky. And there is some political uncertainty too because Turkey will hold its election this year. The second ETF that we discussed, the Simplify Interest Rate Hedge ETF, you can read our research report articles. I talked about this ETF with the provider on a podcast. You can listen to that podcast. You can use the link and learn more about this ETF. So this is what it does. It holds over the counters, over the counter interest rate options to hedge against interest rate movements, and it benefits from market stress. And of course, fixed income volatility was very high this past year, so that this ETF benefited from that. The VANEC ETF that we talked about, you can read our research report and articles and go to VANEC webpage for this ETF and see what it actually holds. So companies like Schlumberger, Halliburton, and Baker Hughes are the top holdings in the ETF, and all these companies reported very good earnings recently. So that is another reason why this ETF has done pretty well. It remains to be seen whether energy can continue to do so well in 2023 as well. Now, looking at the worst performing areas, we know that crypto collapse caused all crypto related companies also to plunge. So Bitcoin fell almost 65% in 2022, and the related stocks of Bitcoin miners, they were beaten down. For example, Bitcoin miner Riot blockchain, it fell almost 90% last year. So this Bitcoin miner ETF and many other similar ETFs were down more than 80% in 2022. Interestingly, this ETF is liquidating today. Today is the last day of trading for this particular ETF. Then the SPAC ETF DSPC was down about 74%, and we know that SPAC boom has turned into a bust. In 2020 and 2021, there was a SPAC frenzy, and more than 800 funds raised about $250 billion. That is according to Bloomberg data. Now, many of those SPACs are struggling to find target companies, or otherwise they will have to dissolve and return money to investors. Then cannabis ETFs were also beaten down. So earlier last year, there was a hope that there would be some legal reforms for the cannabis industry, but Democrats failed to pass any reform. In fact, even the banking reforms, like the Safe Banking Act, there were hopes that that would pass and that would enable these US cannabis companies to get access to traditional financing services through banks. Even that act did not pass. Nothing happened on this cannabis front in terms of legislation. And now, for the next 2 years, there is very little hope for any legal reform because Republicans would control the House, and they are generally not in favor of supporting cannabis. So that is why this ETF was down more than 74%. Then disruptive technology ETFs, particularly those by ARK, they were also beaten down. The ARK flagship ETF, ARKK, and the next generation internet ETF, they were down about 69-70%, though the flagship ETF, ARKK, gathered almost $1.2 billion last year because there were some investors who continued to believe that these disruptive technology stocks are going to rebound sometime in 2023. So it remains to be seen whether Cathy Wood's favorite stocks can come back this year.
Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. And also make sure to subscribe to all our videos so that you do not miss anything. And I'll see you next week.